Our next guest says the Fed is dead serious about keeping rates higher for longer and that chasing high flyers can only end in tears. Rosenberg Research founder and president David Rosenberg joins us now. David, to the naysayers out there, to that thought, they'll say, as we mentioned at the top of the show, the markets have advanced significantly since the Fed started raising interest rates. And so I'm wondering, what have we seen now, the cracks of this starting to appear in terms of the whole, ending in tears bit?
Well, I mean, the stock market hasn't really been rallying since the Fed started raising rates. That was back in March of last year. And last year, the S&P 500, was down almost 20%, for the year as a whole. The stock market at any given moment of time is going to be influenced by a whole range of factors. You really have to take an eclectic approach. And, there's fundamentals, there's valuation, there's market positioning, there's fund flows. And there's momentum. And there are times where you can get a serious momentum-driven market. And so I don't think we can argue a 19 multiple. That's pretty rich. Benchmarked against risk-free rates over 5%, bit of a no-brainer. Of course, we've had the generative AI boom going on, so on and so forth. It sort of looks a little bit like the internet mania we had back in the late 1990s. Again, it was partly fundamental, but that was a massively momentum-driven market. So I don't know if the market's telling you anything about earnings, anything about the economy. It's been a sentiment and momentum-driven market. I think rather devoid of the fundamentals. And at some point, the Fed's tightening, which isn't ending, is going to break the back of something. It wasn't the regional banks. That wasn't the back. The regional banks reminds me of New Century Financial closing its doors in January of 2007 when I was at Mother Merrill, and it was a big ho-hum, and we moved on. But whoever thought we could connect those dots down the road to what happened in '08, between Bear Stearns and Fannie and Freddie and everything else that happened. So the reality is this: unless you're willing to say that hope is going to triumph over experience, how many aggressive, pernicious Fed tightening cycles of the likes we're seeing right now, the most acute tightening cycle since 1981, and people are saying that this is somehow going to end well, that somehow the U.S. economy, a credit-driven economy, is immune to such higher interest rates is totally ridiculous. It just tells me that people can't see past the tip of their nose. The next 12 months is going to be really rough. That's when all the lags from the Fed are really going to be kicking in hard.
Mm-hmm. So the lags will be kicking in, and that's what the Fed believes too, David. So I'm curious, do you think we're fully priced in basically for a hike at the next meeting? November, the odds are going up, slightly. In your mind, is there a possibility beyond 2, or is the variable that the Fed keeps rates much, much longer higher for longer in order to battle what's going on and to get inflation back down to 2?
Well, there's a risk that they will go 2 or 2 plus. And it's not a forecast, just an observation as to what the Fed is looking at. This is not our fathers or grandfathers' Fed. I don't get a sense this Fed has confidence in its forecasts or confidence in its models. It is basically telling us that it is data dependent. And everybody comes on CNBC and they talk about, well, yeah, of course they're data dependent. But I've never seen a central bank so focused on the data that are inherently contemporaneous and lagging. They're focused on inflation. Even though inflation expectations are so well anchored, they're so nervous that at some point the dam is going to break, but they're focused on inflation, service sector inflation. Service sector CPI is in the Conference Board's index of lagging economic indicators. They are anally retentive on the unemployment rate, which is in the index of lagging indicators. And of course, we're talking about non-farm payrolls tomorrow. Nobody talks about the work week. So we're adding more bodies and we're furloughing them simultaneously. It's a very interesting dichotomy. It's like cognitive dissonance. Hire more people, cut their hours. The work week is back to where it was in April 2020 when the economy was locked down. And nobody talks about that. So the Fed's focused on lagging indicators. They inherently take time to turn. This is what the Fed's focused on. And I think they've already, tightening into such a deeply inverted yield curve, which of course everybody says is a relic of the past, ignore the yield curve. They say that every cycle. I think the Fed has already gone overboard. Then again, maybe a recession was always in their plan to destroy the inflation they created through the overly accommodative policies they pursued in 2020 and 2021. So we'll correct one mistake with another mistake. But for the people that say, where's the recession? It's like they were saying the same thing in 2000. Oh, it was in 2001. Where's the recession? I got that in Merrill every day in 2007. Where's the recession? Where's the recession? Okay, yeah. Well, it came in big time in 2008. So, yeah, the lags this time are longer because the Energizer Bunny called the Biden budget buster that was actually gave the fiscal stimulus was a gift that kept on giving. But you see, that's coming to an end. And now we're going to see the full throttle of these lags that everybody's talking about. Well, where are the lags? They're staring us in the face. And I think, right, it might not be this or next quarter story, but it's going to be coming in the next 12 months, or else we'll just take the history books, throw them out. We'll tell everybody that Mother Nature and the business cycle has been repealed and that recessions don't exist. But they always follow the pattern of what the Fed's already been doing. I mean, he's already told us that he's the modern day Paul Volcker. We revere Paul Volcker. Everybody reveres Paul Volcker. He killed inflation by back-to-back recessions, right?